In 2019, Michael Burry sent a message to the financial world that almost nobody wanted to hear. He compared the modern stock market to the subprime mortgage bubble of 2008. Not similar, not reminiscent. Structurally identical, he argued. The instrument had changed, the mechanism had not. Most analysts dismissed the comparison immediately. Burry had made the same kind of warnings before. He was always early, they said, always too pessimistic. But Burry's track record demanded something those analysts chose not to give: attention to what he actually said. Today, we examine the 7 red flags Michael Burry identified in the current financial system. Red flags that exist in plain sight. Red flags that most investors not only ignore, but actively defend. And according to Burry's framework, red flags that follow the exact pattern of every major bubble in modern financial history. Michael Burry is not a conventional Wall Street figure. He did not attend an Ivy League business school. He did not rise through the ranks of Goldman Sachs or J.P. Morgan. Burry was a medical doctor who taught himself investing by reading every financial document he could access. In 2005, Burry identified a flaw in the American mortgage market that virtually every bank, rating agency, and regulator had either missed or chosen to ignore. He read the actual mortgage prospectuses, not the summaries, not the analyst reports, the contracts themselves, hundreds of them. What Burry found inside those documents was not just troubling. According to his analysis, the loans were mathematically designed to fail. The default rates being modeled by the banks were absurdly optimistic. The collateral backing the securities was worthless. And the structure of the market meant that when the defaults began, they would cascade. Burry bet against the mortgage market at a time when housing prices had never fallen nationally in modern American history. Everyone told him he was wrong. His investors demanded their money back. The market moved against him for 2 years. In 2008, Burry was proven catastrophically right. His fund generated returns of 489%, while the global financial system collapsed. This is the man whose current analysis we are about to examine. And according to Burry, the red flags he sees now are not hypothetical. They are historical. They are documented. And they are accelerating. The first red flag Michael Burry identified is what he calls the passive investing concentration trap. When Burry posted his analysis of passive investing in 2019, the reaction from the financial industry was immediate and defensive. Index funds are safe, they said. Index funds are the solution for retail investors. Burry's criticism was dismissed as elitist, as outdated, as fundamentally misunderstanding modern markets. But Burry's argument was not about safety, it was about structure. According to Burry's research, passive investing has removed the mechanism that keeps markets rational. That mechanism is called price discovery. Price discovery is the process by which investors evaluate the fundamental value of a company and buy or sell accordingly. When the majority of capital flows passively, following an index, rather than evaluating individual stocks, price discovery breaks down. The price of a stock rises not because the company is becoming more valuable, but because more money is mechanically flowing into the index that contains it. Burry pointed to a specific structural flaw. The largest stocks in an index receive the most capital automatically, regardless of valuation. As those stocks rise, they become a larger percentage of the index. As they become a larger percentage, more money flows into them. This creates what Burry calls a reflexivity loop. The price rises because the price has risen. According to Burry's analysis, this is not a market. This is a crowded trade, dressed up as diversification. And Burry has noted that the stocks inside passive vehicles, particularly the smaller and mid-cap names, have far less daily trading volume than the funds themselves. In an interview with Bloomberg, Burry stated that the situation resembled a theater where everyone assumes they can exit through the door at the same time, but the door is not large enough. According to Burry, this is not pessimism. This is arithmetic. The concentration is measurable. As of 2024, passive funds controlled over 55% of all equity assets in the United States. The 10 largest stocks in the S&P 500 represented over 35% of the index's total value, the highest concentration in 40 years. Burry's warning is precise. When passive flows reverse, the exit will not be orderly. There will not be enough buyers, and the stocks that rose mechanically will fall mechanically. The red flag is visible. Most investors simply refuse to see it. The second red flag Burry identified is the debt supercycle. Burry has consistently argued that the United States and most developed economies are operating inside a debt structure that cannot be sustained and cannot be exited without severe consequences. The numbers Burry cites are not speculative. They are public. As of 2024, the United States federal debt exceeded $34 trillion. The debt-to-GDP ratio surpassed 120%, a level historically associated with fiscal crises. But Burry's analysis goes deeper than the headline number. According to Burry, the critical flaw is not the size of the debt. It is the dependency on low interest rates to service it. For over a decade, interest rates remained near zero. This allowed governments to borrow unprecedented amounts at virtually no cost. But as Burry noted in multiple interviews, the assumption that rates could remain low indefinitely was not based on economic fundamentals. It was based on hope. When inflation returned in 2022, central banks were forced to raise rates. The United States federal government now spends over $1 trillion annually just on interest payments, exceeding the entire defense budget. Burry has argued that this creates a trap. If rates stay elevated, the interest burden becomes unsustainable. If rates are lowered to reduce the burden, inflation accelerates. According to Burry's framework, this is not a policy dilemma. This is a structural impossibility. The only historical resolution to debt of this scale, Burry has noted, is either default, which is politically unthinkable for a reserve currency, or inflation, which destroys the purchasing power of the currency and every asset denominated in it. Burry has pointed to historical precedents: Weimar Germany, Argentina, Zimbabwe, even the United Kingdom after World War II. The pattern is consistent. Governments that borrow beyond their capacity to repay do not announce default. They inflate. And according to Burry, the data suggests the United States is already on that path. Real wages, adjusted for inflation, have declined for most workers over the last 3 years. Asset prices have surged, but only in nominal terms. In real terms, adjusted for the true cost of living, many portfolios have lost value. Burry's red flag is this: the debt cannot be repaid. The only question is whether it will be defaulted on explicitly or implicitly through inflation. And most investors, Burry argues, are planning as if neither will occur. The third red flag Burry has identified is the liquidity illusion. Burry learned this lesson firsthand during the 2008 crisis. He was betting against mortgage-backed securities that were rated AAA by every major rating agency. The securities traded normally right up until the moment they did not. When enough holders wanted to exit simultaneously, there were no buyers at any price. The securities were not illiquid in theory. They were illiquid in practice, when it mattered most. Burry believes the same structural flaw exists in modern markets, but on a much larger scale. According to Burry's analysis, liquidity is abundant when nobody needs it, and disappears precisely when everyone does. The rise of high-frequency trading and algorithmic market making has created the appearance of liquidity. Spreads are tight. Volume appears high, but Burry argues that this liquidity is superficial. It exists only in stable conditions. The algorithms that provide liquidity are programmed to withdraw during volatility. This means that when markets begin to fall, the liquidity that investors assume will be there simply vanishes. Burry pointed to the flash crash of 2010, the Treasury market disruption of 2014, and the March 2020 liquidity crisis as evidence. In each case, markets that appeared liquid became illiquid within minutes. Burry's concern is that investors have built portfolios and risk models based on the assumption that they can exit their positions at any time. But according to Burry's research, that assumption is false. The majority of assets in most portfolios trade in far lower volume than the portfolios themselves. If institutional investors all move to reduce risk simultaneously, there will not be enough liquidity to absorb the selling. Prices will gap down, not drift down, and stop-loss orders, which many investors rely on for protection, will execute at prices far below their trigger levels. Burry has stated that the liquidity illusion is one of the most dangerous myths in modern finance. It gives investors a false sense of control. They believe they can exit when they choose. Burry's analysis of market structure suggests they cannot. The red flag is not hidden. It is embedded in the architecture of the market itself. Most investors simply do not look at the architecture. The fourth red flag Burry identified is the valuation disconnect. Burry built his career on value investing, the discipline of buying assets for less than their intrinsic worth. According to Burry, the current market has abandoned this discipline entirely. Valuations are not just elevated, they are detached from any historical relationship with earnings, cash flow, or book value. Burry has pointed to specific metrics. The cyclically adjusted price-to-earnings ratio, known as the CAPE ratio, which smooths earnings over 10 years to account for business cycles. As of 2024, the CAPE ratio for the S&P 500 exceeded 35, a level surpassed only twice in history, 1929 and 1999. Both periods were followed by devastating bear markets. Burry has also noted the rise of unprofitable companies trading at billion-dollar valuations, a phenomenon he describes as detached from economic reality. According to Burry's analysis, markets have justified these valuations by pointing to innovation, disruption, and future growth. But Burry argues that the same justifications were used in every bubble in history. In the 1920s, it was electricity and automobiles. In the late 90s, it was the internet. In 2008, it was housing and financial engineering. The narrative changes. The pattern does not. Prices rise beyond any rational valuation because participants believe they will continue to rise. Burry has stated that this is not investing. This is speculation. And speculation, according to Burry, always ends the same way. Not with a rational repricing, but with a collapse. Burry's framework suggests that elevated valuations are not themselves the cause of crashes. They are the fuel. The crash occurs when the narrative that justified the valuations breaks. And once the narrative breaks, the repricing is not gradual. It is catastrophic. The red flag Burry sees is not that valuations are high. The red flag is that almost nobody believes they matter anymore. The fifth red flag Burry has warned about is the Reflexivity Loop. This concept, developed by investor George Soros, describes a process where market participants' perceptions influence outcomes, which in turn influence perceptions, creating a self-reinforcing cycle. Burry has argued that the modern financial system is trapped in a reflexivity loop of historic proportions. Central banks respond to market declines by easing monetary policy. Easier policy inflates asset prices. Higher asset prices create a wealth effect, encouraging consumption and borrowing. The resulting economic activity justifies the initial policy, and the cycle continues. According to Burry, this loop has been running uninterrupted since 2008. Every time markets have declined meaningfully, central banks have intervened with lower rates, quantitative easing, or forward guidance designed to prop up asset prices. Investors have learned to expect this intervention. They have learned to buy the dip. They have learned that central banks will not allow a sustained bear market. Burry argues that this has removed risk perception from the market. Investors no longer price in the possibility of loss. They price in the certainty of rescue. But according to Burry's analysis, the reflexivity loop is not sustainable. Each intervention requires larger stimulus to achieve the same effect. The Federal Reserve's balance sheet expanded from under $1 trillion before 2008 to nearly $9 trillion at its peak. Interest rates were held at zero for over a decade, but inflation eventually returned, forcing central banks to reverse course. Burry has noted that when the reflexivity loop runs in reverse, the consequences are severe. Tightening policy reduces asset prices. Lower asset prices destroy the wealth effect. Reduced consumption weakens the economy. Weaker economic data pressures central banks to ease again. But if they ease too soon, inflation accelerates. If they ease too late, recession deepens. According to Burry, this is the trap. The reflexivity loop that inflated asset prices for 15 years is now running in reverse, and there is no policy solution that avoids pain. The red flag is that most investors still believe central banks control outcomes. Burry's analysis suggests they control nothing except the timing. The sixth red flag Burry identified is institutional complacency. Burry has long argued that the institutions investors trust to manage risk, from banks to rating agencies to regulators, consistently fail to identify systemic threats until after they materialize. Burry experienced this personally in 2005 through 2007. He was shorting mortgage securities that were rated AAA by Moody's and Standard & Poor's. The rating agencies insisted the securities were safe right up until they defaulted. The banks holding the securities insisted their risk models were sound right up until they collapsed. According to Burry, this was not incompetence, it was incentive structure. The institutions were paid to rate securities highly and to sell them widely. Identifying the risk would have disrupted the revenue, so the risk was ignored. Burry believes the same dynamic exists today across multiple asset classes. Corporate debt has expanded massively since 2008, much of it rated investment grade, despite leverage ratios that would have been considered junk decades ago. According to Burry's analysis, rating agencies have once again lowered their standards to accommodate issuers. Banks have once again built portfolios based on models that assume liquidity and correlations that exist only in stable markets. And regulators have once again focused on lagging indicators rather than systemic vulnerabilities. Burry pointed to the failures of Silicon Valley Bank and several regional banks in 2023 as evidence. These banks were considered well-capitalized and well-regulated right up until they failed. The risks were visible in their balance sheets for anyone who looked. But the institutions trusted to oversee them did not look or chose not to act. According to Burry, this is the pattern. Institutions exist to preserve stability, not to identify threats. By the time they acknowledge a systemic problem, it is too late to prevent it. The red flag Burry sees is that investors continue to rely on institutional assurances rather than conducting their own analysis. And according to Burry's framework, that reliance is misplaced. The institutions will not warn you. They never do. The seventh and final red flag Burry identified is retail investor behavior. Burry has noted that one of the most reliable signals of a market top is when retail participation reaches extreme levels. This is not a criticism of retail investors as individuals. It is an observation about the structure of market cycles. Retail investors, according to Burry's analysis, enter markets late in the cycle when prices have already risen substantially and narratives of easy wealth are widespread. In the late 1990s, it was day trading .com stocks. In 2006, it was flipping houses with subprime mortgages. In 2021, it was meme stocks and cryptocurrencies. According to Burry, the common thread is not the asset, it is the behavior. Retail investors chase performance. They buy what has already risen. They justify the purchase with narratives of disruption or innovation, and they enter at precisely the moment when early investors, who understand valuation and risk, are exiting. Burry has pointed to specific data points. Retail trading volume as a percentage of total market volume reached record highs in 2020 and 2021. Options trading by retail investors, particularly short-dated call options, surged to levels never before recorded. Social media communities organized around specific stocks, creating coordinated buying that pushed prices far beyond any rational valuation. And according to Burry's analysis, this was not a democratization of markets. It was the final stage of a speculative mania. Burry has noted that in every historical bubble, the top is marked by the entry of unsophisticated capital. When taxi drivers were giving stock tips in 1929, when shoeshine boys were flipping houses in 2006, when social media influencers were promoting cryptocurrencies in 2021. According to Burry, these are not coincidences. They are signals. They indicate that the smart money has already exited, and the remaining buyers are those who do not understand risk. Burry's red flag is this: retail participation at extreme levels is not bullish. It is a contrarian sell signal. And most investors, Burry argues, misinterpret enthusiasm for validation. So what does Michael Burry's framework suggest an investor should do? Burry himself rarely gives direct advice to the general public, but his methodology offers clear principles. The first principle Burry embodies is to read the primary documents, not the headline, not the summary, the actual filing, the actual contract, the actual data. Before entering any investment, Burry would ask, have you read the prospectus? Have you read the 10K? Do you understand what happens to your capital when the market moves against you? The second principle is to respect illiquidity risk. Burry models the exit before entering the position, not the optimistic exit. The pessimistic exit, where everyone wants to leave simultaneously. If the exit is acceptable under stress, the position is acceptable. If not, the position is too large. The third principle is to act independently of the consensus. Burry was wrong in the eyes of every major institution for 2 years before he was proven right. The consensus is not evidence. The data is evidence. The fourth principle is to understand leverage and hidden risk. Burry's edge in 2008 came from reading the prospectuses and understanding that the risk models were wrong. Most investors trusted the ratings. Burry trusted the contracts. According to Burry's philosophy, the investor who understands the instrument has an advantage over the investor who trusts the label. The fifth principle is to accept that being early and being wrong look identical until they do not. Burry's investors demanded their money back in 2006 and 2007. Burry held his positions because the data had not changed. When the data changes, Burry exits. Until then, the consensus is irrelevant. These principles do not guarantee returns, but according to Burry's track record, they dramatically reduce the risk of catastrophic loss. And in Burry's framework, avoiding catastrophic loss is more important than maximizing gain. Today, we examined Michael Burry's framework for identifying systemic risks before they become visible to the majority. We traced his analysis of passive investing concentration, the debt supercycle, the liquidity illusion, the valuation disconnect, the reflexivity loop, institutional complacency, and retail behavior extremes. 7 red flags, 7 structural vulnerabilities, 7 patterns that have preceded every major collapse in modern financial history. Burry's record suggests that the consensus is wrong more often than it is right, especially at inflection points. The institutions trusted to manage risk consistently fail to identify it. And the investors who survive major dislocations are those who read the documents, model the risks, and act independently of the crowd. The question Burry's work leaves each investor with is a simple one. Are you looking at the data or the narrative? Are you modeling the exits or assuming liquidity? Are you thinking independently or following the consensus? According to Burry's philosophy, the answers to those questions determine whether you preserve capital or lose it when the red flags everyone ignored become the crisis everyone sees. Thank you for watching.